Hi, I'm Bill Baruch, president of Blue Line Capital. I'm here with our analyst, Jannis Meindl. And this is the Triple Play podcast. It's the second episode. We are going to start off with a global macro backdrop and then give you three stocks, hence Triple Play, three stocks that are on our radar. Two we really like. One of them we own. We'll get to it. Jannis, let's hop in.
Yeah, thanks, Bill, for the intro. So we'll kick it off with the macro here. On Friday, we got the non-farm payrolls data, and all attention was really on the wages, on the average hourly earnings, and those came in at 3/10 below expectations, which was really encouraging to see. And then perhaps even more important was the revision down in the November number, where they revised it from 6/10 to 4/10. So that really triggered a rally on Friday, and that really paves the way maybe more for soft landing. I mean, last week we spoke about the idea that Powell dissected inflation into three categories, and wages being the more sticky component as he sees it. So the fact we're seeing a slowdown in the more sticky component, that's really encouraging to see. And then perhaps one more important factor within the wage report is also, or the employment report and wages as a subcomponent of it, is the fact that we don't see a lot of services inflation either. So in outside leisure and hospitality, services is really encouraging, and I think that's what's really driving markets here heading into CPI on Thursday, but then also the next Fed meeting. What do you think, Bill?
Yeah, you said it. The services inflation is definitely front and center. It was talked about to start the week. San Francisco Fed President Daly talked about the services inflation being too elevated, no real sign of coming down. But markets are, they're celebrating the lower wage growth. They're also celebrating the ISM services data that was a big miss, contracted. We've seen a big rally coming out of Friday. Again, that was halted by some of those comments from the Fed members. Daily, as well as Atlanta Fed President Bostic, ahead of Fed Chair Powell's comments Tuesday morning, and he didn't say much. He left it really alone on monetary policy, and it leads into CPI. Big CPI report here Thursday. Fed is, so this is going to lead into the February 2nd meeting, and I've talked about it. I might have even noted it in the last podcast. I do think that the Fed is potentially going to pause, and we may not see a hike February 2nd. But a lot of that's going to depend on the CPI data we get Thursday. But also, they got to let this cumulative tightening go to work, and they can't let the financial markets know that they're ready to pause until that exact moment. So for now, they're gonna kind of fight that rhetoric. They're going to come off at least a little more hawkish. So it's a little push and pull in the markets right now. But we finished strongly here on Tuesday. So things again are celebrating the somewhat bad news on ISM and the lower wages.
Yeah, and then I think just talking about employment and unemployment specifically, I think it's been a real surprise in terms of how resilient the economy's been. But then it's a question of whether employment is a lagging indicator. I mean, businesses don't jump to layoffs as their first option. They try to cut spending in other areas first before going to layoffs. So on Friday, we saw the unemployment rate come in at 3.5%. And then also we saw labor force participation take up by 0.1%, which was encouraging. That's more people coming into the labor force. There's been a lot of concern in terms of the great resignation, whether there have been a lot of older employees in particular that have just gone into retirement. And so these are encouraging wage dynamics, but also on the employment side, despite the hot unemployment data that we saw. And I mean, the talk's always been that we'd see this trade-off in between tighter financial conditions and then whether we'd see higher unemployment in exchange. And I mean, if unemployment was at 5%, that trade-off would be a lot tougher for the Fed. But as long as it's this low, as long as the labor market's this strong, I think they're mainly concerned with still fighting inflation. And then if we see favorable wage data, that's really encouraging for the economy and also financial assets writ large.
Yeah, I'll interject here real quick. You did point out the Great Resignation. I think that's creating some distortions in the labor data that we've been seeing. And you mentioned the layoffs. I'm really curious what layoffs have really actually filtered into the data. I mean, if there's a lot of severance packages, there's people still on the payroll. It's not translating into jobless claims. Yeah, I think it's an interesting distortion here right now, and labor data is really one of the most laggy indicators of all indicators, and So the Fed got it wrong in 2021 by waiting for unemployment to come down, and they may get it wrong here again.
Yeah, I definitely agree that there are definitely some distortions there. You pointed to those severance packages where you can't file for unemployment, but you're basically already out the door. So we'll see if some of these follow. We'll see some follow through there in terms of challenge job cuts, which basically try to measure how many job cuts have been announced. Those have been extremely resilient still in 2022, despite a lot of headlines around tech companies laying off workers. We saw Amazon laying off 18,000 workers, and those were in the white collar space, not the blue collar space, not the warehousing. So that's interesting. And I think as we think about inflation this year, it's going to be a key theme going forward here with China and whether the reopening is really going to accelerate and therefore pose an upside inflation risk. We saw Nick Timiraos tweet out a couple of dovish leaning perspectives where inflation expectations here in the U.S. are ticking down over a 1 year horizon, but then also staying really well anchored over a multi-year horizon. We saw that data basically getting confirmed by the latest wage data and whether China can push inflation back up in the commodities space will be a key factor here and something to watch as activity on the mainland picks back up.
Yeah, that's a great point. I mean, the China reopening is going to be the question, the timing it. What do we see the first quarter? And that actually brings us into our next segment here, our first stock, Cognex, a company that actually has 30% of their revenue coming from China. You can see here in this chart, revenue by geography, very heavy associated with China. And so that's something here to kind of take into factor. You can see some of the performance of this stock last year. They missed earnings in May. You can see the big drop off last year. They missed earnings the first week of May. China went into lockdowns. I wonder how much that had an impact in keeping the stock also very suppressed through much of the year last year. But ironically, too, it's definitely not a coincidence that you're seeing some light at the end of the tunnel. This Cognex coming out of that hole. A lot of support down there coming out of there as China's signs of China reopening. So it's something to keep on your radar. And the reason why we're talking about this stock today, we don't own it. We don't really have plans on owning it right now. But it's something that we could look at it from the automation standpoint. Last week, we covered Rockwell, which we do own. And Rockwell is more specifically known in the industrial sector. Cognex is more looked at as a technology stock, a little more emphasis on some of the software, and that the customers can sort of manipulate the software, develop the software internally on their end as well. So it's an interesting name to keep an eye on. It's more expensive. You can see from more of a multiple standpoint, more of a tech multiple relative. I mean, that's a loose term here these days where these multiples are, but more of a tech multiple on Cognex, more expensive. But again, Rockwell is one that we own, and we think it's at a good spot for Rockwell.
Yeah, I think it's definitely a good stock to keep on our radar here, especially as China reopens. I'm thinking more of it as a China reopening play, really given its heavy exposure there. But then also one of the things I wanted to highlight in terms of recent commentary by management is their heavy exposure on the logistics side. They highlighted time and again that we saw this overcapacity trend in logistics and e-commerce writ large. And as some of these dynamics are unwinding, they are taking a hit in that regard. So it's not only a China story, it's also a logistics story. And when you overlay the Cognex with the Amazon chart, those are pretty similar price developments since the COVID bottom, basically. So that's basically a tell that they're really dependent on the logistics, and whether we see a pick back up on that as we see encouraging spending data is a key question for the company going forward. And I guess then leading it to the next stock, which is Mastech, it's in a different area, but sharing some of the perspective there. Maybe Bill, you kick it off there.
Yeah, I've liked the stock for a while. I really like the diversification that this company brings. And we've owned it for a couple of years now. And really, one of the things that really attracted me early on was the sticky contracts that they have in the communication space. And then the 5G rollout really through 2021 was definitely a big plus there. So they have revenues that they've seen increase across the board with contracts from AT&T increased by 33% in quarter three, revenue from Comcast up 21% in quarter three year over year, T-Mobile up 50%, Verizon up 42%. I mean, these are great numbers to see this foothold. I mean, it's a buzzy word to be in the infrastructure. I think infrastructure is, you got to have exposure, whether it's mass tech or somewhere else in the infrastructure space. But then not only is it the communications, what also attracted me to was sort of the cleaner energy. They have pipelines, natural gas focus as well. But unfortunately, the revenues took a hit pretty significantly last year due to those revenues in the oil and gas space due to underinvestment. All you hear about is underinvestment in oil and gas as being one of the longer term drivers for price action in the underlying commodity. And you look at that, mass tech is at the forefront in that revenue is getting hit because of that underinvestment. They're not seeing purchases or development within pipelines, and that's obviously hurt mass tech. But they've done a terrific job. Management pivoted. They bought IEA last year, which is in the renewable space. This gave them a great foothold in renewables. And I'll let you touch on that a bit more. I won't take all the time on it, but I think it's a really great space to be in right now. I'll let you take it from there.
Yeah, I think it's definitely a great stock because you're covering a couple of different bases, as you mentioned. You have, on the one hand, you have oil and gas, which was really a main revenue driver for them before they made that IEA acquisition. Back in 2019, they had about $3 billion in annual revenue coming from the oil and gas space. In 2022, they project that revenue to be down in the oil and gas segment to 1.2 billion. So that's definitely a major hit, and all of that revenue that's lost on the oil and gas segment was really picked up by the renewable space on the back of this acquisition. I mean, they're really active in wind, they're really active in solar. We had recent commentary by Vice President of Dominion Energy, where he basically said that wind projects are booked out until late 2020s, early 2030s. So Mastech is definitely profiting from that. But one of the key themes that we want to keep in mind as we think about free cash flows, as we think about net income and EBITDA, is the fact that the clean energy space is a lower margin segment. So maybe as we see a shift back to some of the maybe the FERC and other regulatory agencies lower some of these regulatory hurdles for the oil and gas space as the U.S. starts exporting more LNG. Maybe some of these hurdles come down a bit, and Mastech is set to profit from such dynamic going forward, and that is again in the higher margin area. So while maybe the clean energy segment does not really extrapolate forward, as we saw it just in the recent quarters, we do have both bases covered in terms of we have oil and gas, but we also have the clean energy. And of course, then communications is a big trend. You have 5G because it has higher frequency. You do have a need for more towers and micro towers in between. You have higher frequency compared to 4G. That means you need the waves travel less far, and that in turn means you need to have more tower construction. And Mastech will be a key beneficiary. I mean, we can talk more about smart cities, smart homes, and whatnot, but there's so many underlying dynamics with this stock. It's really impressive to see, and I think it's going to be a great long-term play. And also the Mass family owns a major part of the stock. So this is also another dynamic that I like.
Yeah, that was something that really attracted us a couple of years ago, that the family is still running the company. They're still the CEO right now. So I think it's a great space. It's multiple revenue streams. They've done very well pivoting when they need to. And then you pulled the technicals up here. It's a great chart going back to that pre-COVID high. Retested that last year, double bottomed against it, and now we're really breaking out into a new uptrend. So I'm really excited about this stock. We used the pullback last year to really increase positioning in it, sort of in held really a make or break area. So it's definitely something. If you don't own this stock right now, get it on your radar. Infrastructure, 5G, renewables, clean energy. And then again, the free cash flow is refreshed. You're seeing this free cash flow yield pick back up. So it's everything you want right now in a company.
Absolutely. I think you're covering multiple bases there, and that's what I like. You're not just exposed to a pure play in the renewables or a pure play in the oil and gas, although we like that sector. I think it's a great play, great diversifying a portfolio, and especially thinking about long-term capital allocation with the family still in there. And then thinking about long-term capital allocation and M&A activity, credit activity, Let's talk some
Diversification of
about.
revenues, right? I mean, this is we've been talking about too. That's another one that S&P Global hits on. So I'll let you start there.
Absolutely. Diversification of revenue is a big thing. And that's also why S&P Global is ultimately trading above peer multiples. So if we dissect this business into its subcomponents, we have the ratings business, which S&P has duopoly with Moody's. Moody's and S&P combined cover about 80 to 85% of the rating segment. That's because if you are a person who gives money to some of these corporations, then you want to have a reputable company give that rating. You don't want to have some company come out of left field. You will not give your money to that company. So that's the rating side. You have the market intelligence side with platforms such as Capital IQ. That's a highly recurring revenue stream. And then you have things like the S&P Platts platform. You have Commodities Insight and such, which also diversifies the risk of your investment, which is a good thing in our opinion. And then I think you, Bill, want to touch on the fact that S&P acquired IHS, which we used to own, and that's another revenue stream diversifier here.
Yeah, that's exactly. We actually owned IHS last year. It's a market intelligence company, and that's going to provide you the recurring revenues, the data providing, and in S&P Global. I mean, so we ended up with S&P Global shares last year. We ended up. I mean, S&P Global is more of a finance company. IHS is more of an industrial company. What we ended up doing was we actually ended up, I think at that time, rotating into Rockwell at some point. But I think we moved out of S&P and to get some more regional bank exposure at that time. And but now really where we are is been cutting back traditional bank exposure. And S&P Global, we don't own this moment, but it's really the top of our buy list right now. And as we move through some of the slides, you'll be able to see some of the technicals behind that. But I think it's not an expensive stock. It's not extremely cheap. But if we're going to see a soft landing, if we're going to see yields come down, you're going to see new deal flow. You're going to see as well potential moving down some of the issuance that these corporates hold. They're going to roll out, and that's going to create again more deal flow at the core of it. And I think that's great for S&P Global because last year was more of a flat year on the deal flow, rising yields, everybody's sort of hunkering down. So I think that's something that's going to be a very attractive for S&P Global moving forward. But then I think you show the technical chart, and we'll wrap it up. We won't drag this out too much longer, but this chart here, I mean, it's on the verge of breakout. Let's get a confirmation. We got inverse head and shoulders. We've held that gap. We didn't really cover the gap on the downside, but it's a lot of support down there. This company it's really rearing to move. Like I said, if we see a soft landing, this is a stock that's going to perform very well in 2023. But a lot of resistance up there in the mid 160s. And there's actually another gap up top there. We didn't highlight it, but that's when the resistance is there. So if we start breaking down that trend line, I think the upside's pretty big here in this company.
Yeah, I definitely like similar theme as with Mastech in terms of having a diversifier in there in the investment. You have the ratings. If we get a soft landing, M&A activity, refinancing activity in the credit space is going to pick back up. But then you also have with the IHS acquisition in particular, you have the IHS CDX segment, which is basically a family of tradable credit default products. So in case a lot of stress comes into the credit sector, a lot of people will want to have access to the credit default products that S&P Global provides because they now own IHS. And while we saw about $1 billion in quarterly revenues on the rating side back in 2021 when deal activity was really long and strong, right now we see that $1 billion in revenues in the market intelligence segment. So you have a diversifier in there. You have that balance sort of in between those two segments, and that's why it's an interesting stock and one that we have on our radar.
Great stuff. Yeah. Well, thanks a lot for joining us. We'll wrap it up here right now. But again, 3 stocks, you got them all. Cognex, we don't own right now. Mastech, we like it. We've owned it. We still own it. And S&P Global, we have owned. We don't own right now, but it's got to be on top of our buy list at the moment. Thanks for joining us, and catch us again next week. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.